This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. I go wide and diverse today with my guest. We cover the territory, from coronavirus to demographic changes to potential massive stock market drops. We are all over the map. But it's fun. I like having these kinds of conversations every now and again. Dig in the weeds, project some, try and think through what the options are, what could happen, how are we prepared? Are we prepared? My guest today is Dan Ferris. He's the editor of the Extreme Value newsletter with Stansberry. He also hosts a podcast at Stansberry. They have been kind enough to have me on many times, and I thought, given Dan's background, given his insights, it'd be a fun conversation for my show. Without any further delay of introduction, let's jump right into my guest today, Dan Ferris of Stansberry. What's up, man?
How you doing?
Good. Calling you from 4 or 5 hours away from the hot zone.
Yeah, how about that? How you doing over there?
Well, it's impossible to get masks, that's for sure.
No kidding.
I just checked on Amazon. You can't get a mask in America right now.
Shit. I didn't know that.
The panic is hit.
Wow. Is this the bottom?
The bottom of what?
The bottom of the panic. I have a feeling it's not.
There's a doctor, and I asked him, I said, hey, FedEx me some masks just in case. He didn't bat an eyelash, and then the next day he's like, we can't get any for 4 weeks.
Wow.
And they use them every day. Staff of 20 using them every day. That's an interesting one right there. There's something to write about.
Yeah, where is he based?
He's right outside D.C.
Wow. I'm definitely going to write about this because I'm recording our next episode tomorrow. My whole opening rant is about the virus and stuff.
Good. I'll preempt you today. I'll be able to get some of that rant today.
Yeah, there you go.
So listen, here's my plan. I want to just take you, like I told in text, I just want to kind of take you around a bunch of subjects, just two guys talking. And if we end up down one path for an hour, that's fine. Wherever we want to go. Look, I tell you what, since we're there, and since we've started this conversation with the coronavirus, not the beer virus, it's pretty wacky. What is your diatribe that you're going to give to your peeps? Tell me. I want to hear it. I want to hear the early version.
Okay, the early version is, well, there's a couple of subjects here. One is the numbers coming out of China. And as we speak, the number of reported cases just went over 20,000. I think the number of deaths is 400 and some. I suspect that the numbers are underreported. I suspect this because, and you know this better than me, based where you are, it's a communist country. It is a top-down communist country. We know how that culture operates. They don't want anyone to say anything bad about the government inside the country. They want to show the world a good face outside the country. We know that they went after people inside the country who tried to sound the alarm early. There was at least one doctor who the government went after him. I don't know ultimately what they did with him, but they censured him. I think they fired him, but I'm not exactly sure what they did for trying to sound the alarm a little early. Now, of course, that's proved to be a bad idea. And they didn't even report the thing. They didn't even really go public outside the country until the illness started showing up. I think it was in Hong Kong. Information flows a lot more freely in and out of Hong Kong. I can't trust the numbers because I don't trust the way that culture operates. Everybody wants to keep a lid on everything, and nobody wants to say anything bad about the government inside the country. So it's a strange thing. There's that. I believe it's underreported. I also think that now that it's out, the effort to keep the economy stimulated, to put a lid on this thing is going to be massive. That will depress them economically in the short term, but we don't know what term. We don't know how long this plays out. There's that depressive effect, and they're going to be stimulating. They already started the stimulus. They came out after the market opened, after being closed, and it was down 9%, like right out of the gate. And they announced that they were going to try to stimulate and prop things up financially. You'll have those two forces in operation with the government trying like crazy. It's like the duck across the pond. We see the smooth reporting of numbers as the duck flows across the pond, but then underneath they're scrambling. They'll clamp down as hard as they need to in order to get control of this thing, if it's at all possible to do so. It's a big economy. I mean, the air traffic alone, it's like 12 or 13% of global traffic. Big impact on crude oil. WTI Monday went below 50. It was like 49 or something. And the Brent and other prices were in the 50s. Maybe the crude oil price gets weaker. Then there's knock-on effects of all this stuff. Crude oil is 1.7 trillion global market. A 20, 30%, say a 30% drop in that takes $500 billion out of the system. Things start to get a little scary there, just alone. Then I think the Federal Reserve will step in at some point. If this continues to get bad, which I think it will, the Federal Reserve, you hear a lot of stuff in the news, they're discounting a cut in June. I think that comes in March now.
A cut to what? What's left?
Yeah, I know. That little thing, that little Fed funds rate stump that's left, they're going to cut it 25 basis points in, people think in June, but I think in March.
Basically, what this is doing, though, and this is such a interesting big picture example, regardless of coronavirus in 2020, it's showing us, for example, I mentioned the masks, it's showing how quickly the virus mindset can spread. So here we have the sale of masks actually seemingly spreading faster, the inability to buy these masks spreading faster than the virus. And this is what's so interesting about this connected global economy. I think this coronavirus in 2020 is the first example of how quickly things can change.
Oh, yeah. There's a great story that a guy named Morgan Housel, you might have seen him on Twitter. So Morgan told this great story about Harry Houdini. Part of Houdini's bit was he had been a boxer and he could say, anybody can punch me in the gut anytime they want, won't hurt a bit. So of course they would tell him when they're going to punch him, and he had a way of contracting his abdominal muscles or whatever, and fist would bounce off and he'd go, see? Guy walks up to him one time and says, hey, I heard about this. Can I punch you? He says, yeah. And the guy hits him before he can flex. He doubled over. Somebody told me there's more to the story, that he had appendicitis before that or something, and he wound up being rushed to the hospital. But it couldn't have helped. It couldn't have helped not to be able to flex. This is the punch to the gut that you think you're prepared for. We all think we're prepared for these things, but we're not. And you can see it. I mean, as we speak, S&P 500 down 2.5% since the, January 17th high, I think, which is not panic, is it? It's not a crazy move. It could be the beginning of something.
Even beyond any short-term market fluctuations, I think a real issue here, and I've seen some people respond like this, the media especially, they'll say, oh, hold on, this is just another something. We've had 20 of these scares in the last 20 years or whatever. And my response is to go, well, what about this 1918, 1919 Spanish flu pandemic that took out 50 million? Which is, it's kind of the Nassim Taleb black swan thinking. You can run around your whole life and saying, oh, we've been scared 20 times and it was a fake scare. But when the one hits, it's all over.
Right. Spanish flu is an interesting case because the mortality rate on that was 2.5%. But so many people got it. The medical care was so terrible. It's funny because I'm glad you brought that up, because there's something weird. If you look on the Johns Hopkins has a map and a dashboard that you can go look at to stay updated on the numbers. You notice that the deaths just in the region around where it started are much higher than anywhere else, just as a percentage. I wonder if that's a sign that they're underreporting deaths elsewhere in China, because there's a lot more cases, or if it just means that they got caught flat-footed and the medical care was overwhelmed, because obviously in 1918 there was no medical care. It was absolutely overwhelmed with tens of millions of people dying. In this case, it's a smaller footprint, but I wonder if they just were caught off guard.
Let me throw something out there, too, as we speak about China. I mean, look, it's a terrible situation, but it's worth putting in context how different China is than most places. America is 350 million people. China is 1.4 billion. This is a dramatic, I mean, this is so entirely, it's like 3/4 of America's. It's crazy. People need to remember, too, you mentioned this culturally, but when you land in mainland China, not Hong Kong, but when you land in mainland China, hey, forget it. Google, Facebook, Dropbox, YouTube, this stuff's gone. Now, you don't really feel, when I'm there, I don't feel some kind of really odd oversight, but the rest of the world really doesn't exist when you land in mainland China.
That's right. And it's funny because everybody thought coming out of SARS in 2003 that it was going to be more open. That was the narrative in the press. But the exact opposite happened. They've clamped down harder on all internet and media and just society in general. But you're right. You talk to people who are there, who live there, they say, oh, it doesn't feel so bad.
Let me play devil's advocate. Let me take the Chinese defense as we just kind of go down some tangent here. If I'm the Chinese government, if I'm the Chinese people with that huge population, which was going to need to become internet-fied, was going to need to all come online, and it has, why give all my money to the Google guys and Zuckerberg and Bezos? Why not keep the money in-house? To some degree, with Tencent and Alibaba, could we not make that argument that China just said, forget it, the rest of the world, we're going to build our apps and build our technology in-house, and you're not going to get the benefit of taking 1.4 billion people and all their commerce?
Well, sure. Okay, fine. But why deny your people the ability to find out that there's other information in the world? We know the answer, because you don't want them to know, because you want to control the narrative in their lives. But I get you. I understand. If you say we're going to grow this economy, it's not going to be like the old China, we're going to be more entrepreneurial, et cetera, all the things that have happened, maybe culturally they still just have this idea of controlling everything so much. They don't understand how letting the economy open up is better for them.
If I was also to continue to take that China defense, they might say, hey, hold on. You guys showed up, a bunch of Brits showed up on boats and started taking land from us and feeding us opium and all kinds of things. Why should we trust Western powers? You guys have not done that good to us over the centuries.
Hey, I wouldn't argue against that. I understand the logic of it very well, but it's one of those things in life. It's sort of like you get mugged and you never leave the house again. Because something happened once doesn't mean that it needs to happen again in that same way. It's typical of folks to kind of fight the last war in that way and to be afraid of what has happened in the past happening again in the future. I won't say it doesn't make sense. I won't say their culture is stupid and doesn't make sense at all.
Yeah, how many people have they brought out of poverty in the last 25 years, right? It's crazy.
I know, and the way they've done it, just say, this is going to happen. We are going to make it happen for the entire country. That ain't the way it happened in the United States, man.
They seem to be more capitalist than we are right now.
Well, I don't even know about that. I mean, they're getting wealthy at a bigger pace. The real mystery is we had this idea of free and open markets. They have a different idea. I wouldn't call it free and open, but it's certainly, they're letting people get rich and they're financing anything and everything. And their government wants to stimulate and grow and grow and grow. And they'll borrow and stimulate. They're not afraid of that at all. Not at all. That's how they've done it. It's just an interesting case, isn't it?
You said that when I just brought up, and I said, well, they're maybe more capitalist than we are. And that kind of caused you to pause, and you didn't like the way that I said that. Maybe I should clarify, instead of going down the political descriptor route like capitalism, let's just see if we can come to a common agreement. And I think this is kind of true for people that have traveled the world. The Asian merchant mindset is different than America. For example, I just find that people in Asia, regardless of country, have a merchant mindset to sell, which I don't know if we have as much in America. I think we've kind of made selling more difficult.
Yes, I totally agree with that. You see it in China a lot, and if you travel around India, You see it a lot. Traveling around India when I did, I don't know how many years ago now. Where I was down south. I was in Chennai and a couple smaller places. You just drive along through a city and see little business after little business. There are very few, I mean, comparatively few to what I was used to in the United States, tall buildings. It wasn't like the typical central business district, but everybody had their own little stall and people were fixing motorcycles and selling little sundries, cigarettes and candy and whatever, all over the place. On the side of the road, in the middle of the highway, there's a guy with a table and he's selling cigarettes and candy and stuff. That's all over that country. I totally agree with you. The mindset throughout Asia is much more, what do we call it? Call it entrepreneurial or just sales oriented, I think. Sounds like what you're going for. And
The hustle mindset, the merchant mindset, yeah.
Yes, the hustle factor in Asia is much greater. I wish we had that. I wish we had more of that here.
I tell you what, let me shift you out of China and coronavirus and masks and all kinds of crazy stuff to one of my favorite authors who I've not talked a lot about on this podcast for the last few years, and I follow his logic. I don't disagree. I don't understand all the fundamentals as the way he sees it, but I really have liked John Hussman for a long time.
Oh, yeah.
What I love is he maps out a scenario, and he has been mapping out a scenario of, look, we can do all of these things at the Fed and the federal level. We can engineer things, but markets can't go up forever at such a trajectory without having to pay a price in the future. Why don't you explain, because I know you've written and complimented John's work. You've written about it in your newsletter, but why don't you go ahead and explain John's perspective? Because I think, for example, here's one to jump off on. He'll say, look, we are so extended as to right now that if we stopped here at this peak, you really shouldn't expect any more market return for 12 years. That's like, whoa, we're not going to get any returns for 12 years? That's not exactly what he's saying. It could go straight up from here, but the longer it keeps going straight up, the more downtime or sideways time you can expect into the future.
Right. So that's just, when you think about it in the simplest terms, that's just the basic idea that we should all understand as investors. The more you pay for a given asset, the less return you're going to get out of it. So even if it's a really good business or a really good asset, generates a lot of cash flow, one guy pays, say it's a stock or something, and one guy pays $20 a share, he's going to make less than the guy who paid $10 a share. And that's the basic idea behind that 12-year scenario that Hussman reminds us of again and again. But my thing with Hussman is that, okay, so for a long time, I thought about the overall valuation of the stock market. I tried to track it and I thought it was important. I just sort of got over it because I realized this is a useless exercise. Then I figured out that there are two times when you care about this. That's at extreme lows of valuation and extreme highs of valuation. What Hussman has done, he has done the research and found these 5 metrics, which, let's say, I should know all 5 of them off the top of my head. One of them is price to sales. Another one is price to margin adjusted CAPE, like a margin adjusted cyclical PE ratio. And there's a couple other things. But the basic idea is he's found these things and tested them so that historically speaking, they have the most negative correlation with the S&P 500, meaning when they are at their lowest level, historically speaking, returns have been highest in the S&P 500. When they've been at their highest level, returns have been lowest over the next several years in the S&P 500. To me, that's my focus on him. People have criticized him because he was bearish for a long time as the market marched up, and he was bearish. He was hedging. He was long, but he was hedged, and he was losing on these hedges. He changed some of that in his portfolio, but I don't even care. People criticize that, and I don't care about that because I'll tell you what, Michael, valuation is a good thing to know about, but it sucks. It absolutely sucks as any kind of a timing indicator. It's really about, are assets priced for a good return or not? The S&P 500 is not. That doesn't mean stocks aren't going to go up. It doesn't mean you're not going to find good deals. It just means that overall, in my opinion, actually, overall, when that valuation hits an extreme like it's at lately, you want to be more careful. That's really all it means to me. And he's the guy who I sort of go to and check in with to track that. And he publishes those 5 metrics quite regularly and comments on them regularly.
So you know my perspective. I come at this from a trend following perspective. I don't discount the fundamental expertise that many people have, but it's just not my world. So I'm really curious to ask some questions of your own perspectives, interpreting Husband. From a valuation perspective, where are we today via the metrics that he might use or metrics that you might use? Where are we? And why can't I imagine the Dow doubling from here? Why does there have to be some reversion to the mean? Why can't it just keep going up?
I certainly would not be the guy to tell you that it can't, because what people do in the short and even medium term, that's driven by emotions. If people get excited enough about stocks and stay that way, you can see things get to heights that you never dreamed of. Same way in a bear market, things can get to depths that you never imagined. These things tend to happen, cycles happen, but it's not like the law of gravity here. It's just the way human nature works over time. People get too excited, tops form. They despair too much and get too depressed, and bottoms form. When that happens, and how high things go and how low things go in the meantime, hey, you'll never catch me trying to absolutely pinpoint those moments and predict them. I don't make predictions. In fact, Michael, on my phone, I was deleting some notes that I had made. I happened across this one, and it was a quote by the Chinese philosopher Lao Tzu, and he said, "Those who have knowledge don't predict. Those who predict don't have knowledge." You won't catch me trying to predict. I'd like to think I have at least some knowledge built up over the years that prevents me from trying to make a prediction in that regard.
Let me give you some dates. Let me give us some dates that we've grown up with. 1998, summer of 1998, long-term capital management blows up. Things feel really dicey. We recover from that. We make it to the spring of 2000. Boom, the dot-com bubble blows up. We get to the fall of 2002. It bottoms out. The Fed starts rigging rates. They create the real estate bubble that pops. The fall of 2008, we've all seen The Big Short movie about 100 times because it's great. Now here we are after you would have expected some drop of some sort. But here we are. I mean, gosh, we're approaching what? A decade long, over a decade past 2008, and everything is just swimmingly straight up. Rates are pretty much zero or negative, which is the part that I find really interesting because with as extended as equity markets are, with rates at zero, in 2002 and 2008, the powers that be were able to drop rates to reflate things. You'll see where I'm going here, but what I want to know is what happens if this thing drops? We are already at zero rates or negative rates. I mean, do we just go to like minus 5% or minus 10%, and each month they take 5% of our account until we all have zero?
Yeah, that is true. But remember, the drop from just say 5% to 4%, that's a 20% drop. And the drop from 2% to 1% is a 50% drop. When people talk about there's not much ammo left, I don't think they're really looking at it the right way. I think they're just looking in terms of bips, basis points, not in percent drop in interest rates. Although it is true, we're not at 6%. Put it this way, you're right that there are fewer 25 basis point cuts available. There's certainly that. But these people, central bankers, they don't really care about any of that, I don't think. The zero bound kind of, certainly in Europe it came and they didn't care. They were willing to push that envelope. Of course, now they're backpedaling. The Reichsbank is backpedaling. And that's the oldest central bank around. That's one of the oldest banks, period. They've made it through a lot of stuff. They want to get rid of negative interest rates, and maybe others will pick it up. And the peak, I think it was August 20, gosh, my years are getting screwed up here. August 2018, 17 trillion in negative yielding debt, and now we're down around, what, 11 or something?
Let me throw it to you back this way. We get, like we saw in 2002, like we saw in 2008, the S&P, and this is just a hypothetical talking, The S&P drops 50%. We're at the current rate levels we are at now. You project for me what the Fed will do. For example, the S&P drops 50%. Rates are where they are today. What will the powers that be do in that scenario? That's what I was driving at with that whole initial setup.
Well, if it happens suddenly enough, say it happens really suddenly, I mean, you'll get a 50 bips or more cut just right out of the gate. I don't think it's difficult to guess at that one. We know they're not even hiding anymore that they're in the game of supporting interest rates, supporting asset prices through operations in the bond market, in the Fed funds market. Right now, they're at 1 3/4, 1.75. That's 25 bips cuts or 3.5, 50 bips cuts. Cut it up any way you want. That's the ammo that is there. If we do get that 50% drawdown, yeah, for damn sure they'll be cutting like crazy. I don't think anybody doubts that. You and I both know these things tend not to happen that suddenly. Down 50% usually takes at least some time.
I like that word usually, though, as we were talking about the coronavirus and the fall of 2008. It seems like that maybe, and maybe this goes with this conversation, is that when you have a world that is as connected as it is today, if you can press a button and tell the whole world you might get coronavirus, all of a sudden you can't buy a damn mask on Amazon. Can I extrapolate that out to what people might do if they perceive that it's time to get out of stocks?
Not at all unreasonable to do so. Absolutely, I think you can. You're right. The world is more connected than it's ever been.
We weren't this connected in the fall of 2008, not with the social media.
No, we weren't. Not with air travel, not with anything. It's a more connected world. Even despite whatever Trump has done, going from multilateral trade agreements to these bilateral things, more connected in terms of global commerce. Yeah, it worries me. I wonder about the potential for a Black Monday type of thing, 1987. I wonder about the potential for that, like a one-day, pick your percentage, Michael, 30% or something. I wonder about the potential for that. It's nothing you can even really guess about. You can just surmise that as connected as we are, we have liquid markets, money moves fast, people get scared, and if something happens, we could see a day like that. I think that's entirely within the realm of possibility, but it's whether or not it's within the realm of probability. And I will say this, I think it's a lot more probable, certainly than the options market thinks right now. Even after what's happened the last couple of weeks, I can still get some pretty cheap put options on the S&P 500.
I'm not trying to push you down a crusty bear path today in this conversation.
Don't have to. Yeah.
It seems like maybe we've reached that magic moment a decade past, more than a decade past 2008, where people have forgotten. It's a distant memory. I mean, The Big Short is just fun to watch because Michael Burry is missing an eye and there's Steve Carell or whatever is a great actor. Have we lost touch with the memories of how things can go bad?
Yeah, by the way, just as a side note, I understand from people who actually know Burry that he's not quite as weird as Christian Bale made him out to be. Just want to put that out there. But you haven't pushed me down the crusty bear path. I've been cautious. All my listeners and readers and everybody knows this since about the middle of 2017. And of course, it's been wrong to be too cautious on U.S. stocks since then because they've kind of gone up very nicely. I'm still that way, and the higher they go, the more I think it's still the right thing to do. And I'm not at all afraid to miss out on a little something because to me, the worse it gets, that is to say, the more expensive stocks get, the worse the returns you can expect.
Well, this gets back to Hussman.
Yeah. Just take the easiest number that he tracks to talk about is price to sales. At 2.4, we're at an all-time high here. It's higher than the dot-com peak, for one example. That was, I think, the absolute tippy top there. March 2000 was 2.36, and we're at 2.40 something or other. Technically speaking, higher than then, but in rough terms, we're there.
Do you ever envy these trend following guys who just say, oh my gosh, the fundamentals just don't make any sense. There's no logic, there's no rhyme, there's no reason. Let's just follow the damn price action up or down and have no feelings about the underlying fundamentals.
Well, as a value investor the past decade, I live in constant envy of those guys because they've been riding up and up and up. And I've been sitting here for almost 3 years going, man, things are starting to get really speculative and frothy and expensive. They've been right, and I have been something other than right in that regard.
You mentioned Burry. Burry has actually come out with some criticisms, I guess, as of the index funds, I believe it is. And he really sees that the way those are put together can force money into particular equity issues that really just don't deserve to have the money. And then he points out that, again, if everyone starts racing for the exits, you could really see some acceleration on the downside.
Right. I think the worst phenomenon that I can figure out, I'm not saying I know everything or have done a ton of work, but the worst phenomenon in the index funds that I can see is overrepresentation. ExxonMobil is a classic overrepresented stock. It's a growth stock. It's a value stock. It's a dividend stock. It's a materials stock. It's in a million different funds. I mean, it's all over the place. It's everything to everyone. But what it really is, and this is the real point, is a highly liquid stock. That's the real point. That's why so many of those names get overrepresented. If you look at the growth and value funds that could be put out by the same company, they wind up with some of the same stocks in them. I mean, how does that work? That's crazy, right? But that's what happens. If you get these overrepresented names, there have to be underrepresented names, the smaller, less liquid names, or those that don't appear in any index at all, maybe. You see money going out of one and into the other. And at some point, one would assume that if we do get an ugly moment, Corona gets really ugly or something else sends this bull market into a bear market territory quickly, the money goes rushing out of wherever it can. We saw that phenomenon in 2008, didn't we? People sold whatever they could because all the mortgage crap they bought was so illiquid it couldn't move fast enough. So they sold stocks, like all of them. And it didn't matter. That's the concern that I have, is that the highly liquid names that everybody is in love with today, the large cap liquid names that everybody loves because they're the greatest businesses on earth, Amazon, Google, Apple, Facebook, et cetera, they wind up performing a lot worse in a downturn, I think, due to this phenomenon of being overrepresented because they're so liquid.
Big picture stuff. Demographics. So I grew up in the Washington, D.C. area. If somebody was buying a home in the 60s or 70s, dozen miles, 20 miles outside D.C., maybe they were paying 50 grand or 100 grand. Very likely today, that same 16,000 square feet of land with a tear-down house, the land is perhaps worth $700,000. You put a new McMansion on it, you're at $1.5 million. You've got a lot of people in their late 60s, their 70s, their 80s that are sitting on huge moves in their real estate. They bought in the 60s and 70s, and now they've just made a boatload. Well, if you look at the rate of return on an annual basis, maybe not that huge, but at the end of a lifetime, it's a pretty big asset to be sitting on. Now, if I compare and contrast that to a high school student now or a 20-something, I don't see how those kids have a chance to make the kind of money to buy the same kind of house that either their parents or grandparents own. I don't see where those kids are going to get the money from. I mean, the real estate has gone up so damn high. This is an interesting conundrum, I think, across America, that we're not really looking at the differences in demographics and what those demographics can do over the course of a lifetime. But it's a really interesting phenomena that I think we really have reached the point. I think it's a worthy argument that not every generation is going to do better than their parents.
Right. Yeah, I have heard this. I mean, you can't miss it. There's quite a bit of this around this discussion. My general sense of demographic arguments is that I don't know that they always play out the way you expect. People, they tend to look forward and see these changes and view it as kind of an emerging trend that will move in a certain direction for a certain period of time. And in reality, they tend to play out a lot more lumpy and a lot more cyclical. Housing is a cyclical industry, for example, and those related to it.
But hold on, but before 2008, no one called housing in America cyclical. They called it straight up.
Absolutely. And of course, that was their downfall. They said, housing prices that don't fall, we can do all this garbage. That was bad for guys like me because that's why people soured on value investing, because all the banks and home builders and related commodity type producers and other sort of value companies, even mining companies and everything, all that stuff got destroyed in 2008. And then that was when this big run up in the growth companies started, because people look back and say, well, I'm not going to buy that stuff anymore. I hear you.
You don't seem to like the idea where I go down the path to say that, hold on, there might be one particular demographic, the boomers right now, who have got a distinct advantage over millennials. You don't seem to care for that argument.
No, I don't not care for it. Double negative. I understand it. And I don't think it's wrong. I just think that these things, they play out. I think it's more important, for example, that housing and interest rates and the commodities and businesses that support housing tend to be cyclical. I think that winds up being more important over the longer term than the demographic change. That's my point. Your demographic could be spot on, but I think the way it plays out in financial markets tends to be more cyclical anyway. Occasionally, we do get that pre-2008 kind of super cyclical phenomenon. Maybe there's one of those cooking in what you're telling me. But that's just, I think of it less as a top-down phenomenon, and I focus more on how I expect those industries and commodity prices and things to behave, and interest rates, like I said, over the long term.
One last final area I want to touch on, a little bit of politics connected to the markets. One of the most interesting things I've found for the last 3 years, I guess since Trump took office, is, man, boy, does he want to take credit for the stock market. And boy, has it gone up, and he gets to take a lot of credit for it. What in the world? I mean, it's not even there's no speculation here at all. If the stock market takes any kind of a you-know-what over the course of 2020, heading into the election, let's say there was a 20 or 30, 40%, perhaps even 50% drop. I'm just speaking hypothetically here. He's out. I mean, the American public will vote the stock market.
Period. Absolutely. He's in as long as we stay up. The thing drops, I would say, Michael, if we get a 20%, people are feeling that 20% bottom in November.
He's out.
Screw him. He's gone. Likewise, these events tend to be rare. If I had to bet right now, I'd say, yeah, not going to happen. He's in. But you're absolutely right.
I mean, I think if you go back to the fall of 2008, I really doubt that if the market chaos that unfolded had not unfolded, it's hard to imagine that Obama would have won. I think McCain would have won. If we go back to 2000, if the dot-com bubble had not imploded, come on, America would have rewarded Al Gore with the presidency. George Bush never would have had a chance. It all comes down to the stock market.
Yeah, I think a great deal of it comes down to the stock market and how people are feeling. How are things right then in November when it's time to pull that lever down? How do they feel? Have they lost a job? Is their 401k down? Have they had to change a plan for how a child gets educated or whether or not they take a vacation? All those real decisions times 60 million. And it winds up having a lot to do with the lever they pull and how they feel about what the different candidates are saying and who's in office when it goes down.
Yeah, and I wasn't trying to make a value judgment here on this with Trump. I probably align my thinking with his overall kind of macro perspective, not necessarily personal behavior. But I just point this out that, look, if the stock market drops, given to how much credit he's taking for it, I mean, it's obvious what will happen.
Right. I agree. And I don't even know if the credit that he takes for it, that just kind of amplifies it. It reminds people to blame it on him.
Exactly. And he has taken more credit for the stock market than any other president I can recall in my lifetime.
He certainly has. You barely see presidents acknowledging its existence because they know it can go the other way.
Right. They know the risk.
Yeah.
But he's a high risk, high reward guy. It's an interesting time for us as Americans to watch how he plays the game. So far, he's played it very effectively.
Oh, he has. He's run circles around the competition the way he operates. They still haven't figured it out.
Yeah, it's amazing.
Yeah.
Even this is, I mean, look, I think it's terribly mean, but for him to come out and say that Mike Bloomberg is negotiating for a box to stand behind the podium, clearly this is not true, but he does it to rile everybody up. Then the next thing you know, CNN is running a chyron that says it's not true that Mike Bloomberg needs a box. Trump, in one tweet or one comment, has the entire country talking about whether or not Mike Bloomberg is too small and needs a box. Insane skill.
Yep, it is. People hear that and they say, oh, they criticize him, but they don't understand the utter genius, given where the culture is these days. They don't understand the genius in it. I almost hate to use that word because he calls himself the stable genius. But if you look at this as what it is, as a marketing campaign, and I always say, at this point in our history, the skill sets are too different. A guy who could really do well in office can never get elected. A guy who can get elected cannot be expected to do such a great job in office. You can expect a guy like Trump to get elected. He has the skill set down pat, proved it beyond a shadow of a doubt. He's never stopped campaigning, really.
Yeah, someone said the other day, I saw this comment, or it was a tweet, and they said he's a combination of Sun Tzu, Art of War, Saul Alinsky, the radicals guy with all the political strategy, and WWE wrestling, all combined together.
That's pretty good. I might have thrown David Ogilvy in there, the advertising guy. But yeah, absolutely. That's a good insight.
Dan, where can we send people? Where would you like to have them go? They can make it to Stansberry, but is there a particular website or beyond Stansberry you'd like to send people to?
Sure, they can go to investorhour.com. That's the Stansberry Investor Hour podcast that I host every week. They can find us there, and they can find us at I write the Extreme Value newsletter for Stansberry. They can find that at stansberryresearch.com.
Cool. Dan, it was fun chatting. I hope I did not surprise you with all of my directions going off like octopus tentacles. I mean, who knows where I was going to roll with you, but I know you can roll with it all.
Yeah, not at all. I'll talk about anything, anytime. And talking with you is more fun than talking with a lot of folks. So any old time. Yeah.
Hey, Dan, thanks again. Appreciate it.
Okay, sir. I will, hopefully we'll talk again soon, huh?
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.